Well, good morning there, folks. Inflation is still at 4.6%, well higher than a stable economy's classic 2% target. And today, it is Wednesday, May 3rd. Today we'll see the FOMC rate hike decision for May. Just 2 days after the collapse and takeover of First Republic Bank, the Federal Reserve will be deciding on interest rates once again. And just as they raised in March, there's every indication that Fed policymakers will enact a 25 basis point hike. That's 0.25%. To give a refresher on why First Republic Bank is even involved in this conversation at all, is because it's the third bank within 2 months to fail and go bankrupt. As these banks, Silicon Valley Bank, Signature Bank, and First Republic Bank, primarily invested in long-term bonds, they experienced falls in yield, and the results were unrealized losses. So when classic run-on-the-bank scenarios finally occurred on banks, the banks were forced to liquidate those said long-term bonds at a far discount to their, par value, leading these banks to go to ultimate failure. All these long-term bonds simply lost money because the yield on the bond rates went way higher as the Federal Reserve increased interest rates. So imagine buying a 10-year bond that pays 1.5% per year. Now imagine the entire market of bonds goes up to offering 3.5% per year. You don't care because, if you hold your bond for the full 10-year period, you get your principal back plus interest. But in the case of these banks, if you need the cash right now, you need to go to the secondary markets and sell the bonds today. And this puts a significant cut on the face value of your bonds because your 1.5% bonds have to compete in a 3.5% bond market. So, for instance, 1 million, 15,000 is 1.5%. That 3.5%, that bond has to come down to $430,000 in order to compete in the first year, still offering $15,000 a year. And this was the problem. Silicon Valley bought $91 billion in treasury bonds and U.S. mortgage-backed securities between 2020 and 2021. A lot more than $1 million, $91 billion. And so while we do have this problem with having had many regional banks in the US take on long-term debt in times of rising inflation, the Fed is expected today at 2 p.m. Eastern time to power through and still raise the benchmark Fed funds rate 25 basis points, or 0.25%, from a range where it was 4.75 to 5%, now raising it to 5% to 5.25%, which is in fact the highest rate that Fed funds rate have been since 2007. All right, some comments here. Federal Reserve Governor Christopher Waller said that he favored more monetary policy tightening to reduce persistently high inflation, although he said that he was prepared to adjust his stance if needed if credit tightens more than expected. It seems apparent that they're going to hike, said Michael Ferroli, chief U.S. economist for J.P. Morgan, Chase and Company. You're also hearing more and more about a pause. So it seems like, they want to pause, but they know the inflation job isn't finished here, end quote. Bloomberg's chief U.S. economist Anna Wong had this to say, quote, signs of softening economic data and tightening credit will likely drive a consensus on the committee that rates are sufficiently restrictive, hinting at a bias to pause at the next meeting. But with inflation stubbornly elevated, Fed Chair Jerome Powell will stop short of assuring markets that a pause is a done deal or that rate cuts are imminent. Okay, folks, with that said, we'll be looking forward to the 2 p.m. Eastern rate decision by the Fed, followed by the chairman Jerome Powell delivering a statement 30 minutes later. Now, if you're following what we usually do, the antics on this channel, we'd be following what the Fed does during the day of the Fed rate decision so that we can do a little bit of day trading or swing trading to make a few extra dollars here on the channel. But for now, I'm reporting the news, and my name is Bruce Bradbury. Of course, if you haven't subscribed or liked the video yet, I please assure you that that is a good decision to make. I'll see you next time.